having that internal debate.
Good afternoon, everyone. We're Team 11. We're going to present the company John Deere, and our slogan is "Nothing runs like a deer." This is Angela, this is Cyrus, this is Jobby, and this is Dream. All right, let's come up with a brief company quick overview. The company was founded in 1837 and is listed as almost 200 among those 514 companies. And Deere is one of the leader on the farm and construction machinery industry, and also is best known for the tractors and agriculture. And it remains the world's largest maker of farm equipment. As we can see, it takes 60% of the farm equipment market in North America, and also it's now experiencing expansion in Canada, Brazil, Europe, and Asia. Here is the stock analysis in the past 3 years, and we can see there are two peaks in the 2011 and 2012. We'll further analyze the stock issues later part. And here are the 3 segments the company heavily involved in. There are agriculture, construction, forestry, and financial service. As we can see, the agriculture takes most of part of this. It's almost 75%. And here are the SWOT analysis. We give a brief overview of the company itself. And I do want to mention each point in each sector. As we can see in the strengths, the company have a very strong brand recognition and customer loyalty. And the surprising is they have 91% repeated customers on their history of since 1837. It's very amazing. So, and also the weakness, as we can see there, the company has recently experienced several large recalls on their tractors they sell. Basically, they're complex and advanced. So we might put a question mark on the company about the sustainability and quality management of the company. And there are a lot of opportunities as we conclude mainly in 3 parts: the food increasing, the construction increasing, and also the emerging markets. And the threats we understand there are very intensive local and competitive drivers, and also the meeting the needs of the unique local market preference is facing the company in the future. So we come up with a brief industry overview, which is also an extension of the company opportunities it's facing. As we can see, in those 3 industries, the company segments involved in, they all have a positive sign of increasing 5%, 10%, and 20% respectively. And also the emerging market is growing at a faster pace than the existing markets. And the 2 basic questions about the food and infrastructure. Here is the graph to show you how the infrastructure is going to grow. The data shows that until from 2008 and 2020, the infrastructure will grow at 3.6%. And all those growths are coming from the China, US, India, and those are the markets which the John Deere already have a plan to expand, or they're already in the market exist. And here the cash receipts of the farm industry, the cash receipts represent the monies in the farmers keep. And as we can see, regardless of the economic volatility in 2009 and in the early stage, the cash receipts is keep increasing all over the years. And we understand that the government's support of the farm industry is very important for the growth of the farm industry. And here we list several key companies with key countries like the government support. This is India. They're experiencing steady increase. And the next is China, and they're also increased. And the next is Brazil, and we can see they are still heavily investing in this farm industry from the government side. So that's all proof that since the food increase and the food demand will increase, the government support for the farm and farm infrastructure will also increase. And here's the price of the major foods. There are foods, grains, fats, oils, and other foods. This is from World Bank since 2007 until the 2012. They're the most stable over here, but we still look from the increasing positive future. And here are the competitive positioning we analyzed based on the 5 forces. We conclude that the company has a high barrier to entry, high buyer power, high degree of rivalry, and moderate threat of substitute, and weak bargaining power of supplier. But we're going to explain why we choose these companies later by my teammates. So let's welcome Jobby to give us an investment opinion.
Thank you, Angela. Well, now we're pretty much looking at the investment opinion. Now, one of the primary factors to do with John Deere is its demand is pretty much directly related to the world population. Right now we're sitting at about 7 billion, and we're expecting the population to grow up to around 9 billion by the year 2030. So this pretty much demands a lot more efficient equipment, which is pretty much met by John Deere. Next thing which we can look at is the with regard to the urbanization. Now, the present trends right now is a lot of population moves away from the more rural areas or the more undeveloped areas to urban areas. And that pretty much means there are a lot fewer farmers in the world left to kind of like meet the present and increasing demand with regards to the food demand right now. So that again means they're pretty much requesting a lot more highly efficient machinery, which is again being met by John Deere. Now, let's look at one of the most important factors for John Deere with regards to its growth is its demands from emerging markets. Now, we all know it. This is not the case just of John Deere alone. This is pretty much the case of almost any company across. Now, just to go a little bit further into what exactly is John Deere doing, or rather, how closely are they looking at emerging markets. With regard to the BRIC countries, that is, start off with Brazil. They right now have 4 existing factories, and they're going to have 2 new ones coming up in Brazil. In Russia, they have 2 existing factories, and they're going to be coming with 1 more. In India, they had 3 existing factories, and they're going to come with 1 more extra. And in China, lastly, they have 5 existing factories, and they're going to be opening up 3 new. So this pretty much shows exactly why are they looking at the emerging markets, because that's where we have the higher growth markets in relation to more mature markets. The next is, as what Angela said, they're looking at financing operations, which has already been started up in China, and now they're pretty much looking at Russia as well. This is kind of like an add-on feature which they're giving to its farmers, because it just makes the farmers a lot more easier for them to purchase the machinery. Now let's look at the technological advantages of John Deere. Now, we all know one of the most important criteria is to meet the customer's expectations year on year. Right now, farmers are pretty much expecting machines which are highly productive and machines in which there's a lot lesser labor required to be put in. And that's exactly where John Deere steps in. And lastly, with regards to John Deere and its target clientele, one of the primary characteristics is the customer loyalty. Now, considering the fact that John Deere has been around for about 175 years now, their selling is more relationship-based selling across to its clients. As what Angela had mentioned before, they have a 91% repeat sale to the existing client base. That shows how loyal their clients are. So irrespective of their slight glitches that they have, which Angela mentioned over the weakness, they would still come back to John Deere. Right?
Okay, now valuation part. We may use two approaches. One is multiples, and the other is discounted cash flow. We pick 5 peer companies, and these companies are all involved in the farm and construction machinery industry, and they are also mentioned as competitors of John Deere in John Deere's 10K. Here we calculated 3 multiples: revenue, EBITDA, and earning. They are those data can be sourced from 10K and 10Q of these 6 companies, and you judges can find it on page 8 to 10. They gave a price range at around 79.2 to 90.5. Then we're going to talk about discounted cash flow. Here's the WACC, the core assumptions of that. Cost of debt, that is calculated from the weighted average of interest rate of all John Deere's outstanding debt. A risk-free rate found from the official website of it's a 20-year Treasury bond yield. Equity risk premium, that is obtained from Professor Demodaran of New York University. Unsystematic risk premium, actually includes 2 parts. One is specific company risk premium, another one is a large cap premium. That data comes from Edison. And tax rate is 35%. That is the average of the effective tax rate in the past 5 years. So then we have a WACC, still beta. Beta is 1.52. That is get from Capital IQ, because we don't want to waste time to do the regression, but we know that beta is 5-year beta. So that is what we want. So just to refer to that. So WACC is 7.9%. And next page. So I still want to focus a little bit more on the key growth drivers. Here's the chart of the revenue growth rate of the past 5 years and the next forecasted 5 years. Actually, in John Deere's 10Q, it forecasts 13% revenue growth in its agriculture and turf segment and 17% in its construction and forestry segment for the fiscal year 2012. But the Wall Street guys, they just reached a median of 12% growth according to Thomson Reuters. But we hold a conservative view. We wanted just to give 11% for the year 2012. And then we think after 2012, maybe the global economy is going to relieve a little bit. So we add 1% increment for every year after 2012. And it peaked at 13% in 2014 and 2015. But in 2016, still to be conservative, we use 11.2%. That is the average of the growth rate in past 10 years. So we reach a target price range at 79.1 to 91, and the target price is 85.4. And this is valuation. Next, Li Jun will introduce financial statement analysis.
Hi. The sales from the operation segments increased 13%, lower than the expectation of 15%. And the net income from the financial services segment increased just slightly, but keeps stable. So we believe John Deere started to step into the declining growth situation in this cycle. And Deere holds a lot of marketable securities for hedge purpose. Since Deere has a lot of clients in the US, the Europe, so under the influence of the financial crisis, it's reasonable to hold that large amount of securities to keep safe. And it also raises debt to about more than 20%. But since Deere access most of the worldwide capital market with reasonable costs and still have the extra credit line, so we believe Deere is not on the verge of the bankruptcy. And the Deere has, in the most quarter, Deere has negative operating cash flow due to the dramatically increased inventories and the trade receivables, but it has already been improved a lot by decreasing 25% deficit. And the next risks, droughts can be risk for John Deere because since even though farmers will not lose a lot in the droughts due to the increased product price, but they probably cut the plans to buy or upgrade their equipment. And then the Europe debt crisis. Under this crisis, European clients may cannot afford, sometimes cannot afford the debt or the loans, so that will be a risk. Then the high debt burden of $31 billion for John Deere, that surely will take the liquidity risk. So based on our analysis, John Deere has a lot of comparable advantages, and tell the truth, as a mature company, John Deere really has a relatively high growth rate. So we believe John Deere still have the potential to grow more in the future. And under our valuation model, we got the 85 target price, and the range is to $91, and the previous close price was $84.69. So based on this information, we gave our recommendation of hold and watch the stock. When the stock goes downside, it's time to buy the stock and wait for the booming in the next cycle of the year. That's it. Thank you.
When you were estimating your revenue growth, did you compare it with what the overall market for their products are growing, and looking at market share, whether or not they would lose or gain market share, or?
The industry's growth, average industry growth is estimated at 11. I forgot which website, but
You basically are looking for them to grow along at the same rate as the market,
yes,
correct?
yeah. Usually John Deere tend to outperform, but we still want to be conservative. Especially John Deere's next 10Q is going to release in November 23rd.
Yeah, have they already reported for the third quarter yet?
Yeah, already. It's it publishes in August the 15th. That is the third quarter. A little bit different from
And
those.
how did they do versus, because the quarter before that, I think they missed,
They
correct?
missed the expectation of those analysts.
Well, that's because of the drought. The middle U.S. is not and also the fall expectation in the emerging market was because of the weather condition and environmental issues.
What percentage of their business is in the emerging market?
They're just started. I mean, they built their factories around 2011.
Actually, here's the graph about that.
Yeah.
Just,
So in other words, the growth rate's gonna be phenomenal because they're just entering it, right? But right now, it's not really having much of an impact on their overall numbers, right?
because the fastest growth place like the Asian, this place, but the sales there does not take that much portion of the whole sales of John Deere. Most of them from North America and Europe. No, industry overview. No, investment opinion. Upper. Yeah, this one. As we see. The Central Europe, but you can see this means the portion really small. But most of the portion are from North America, U.S., Canada, and Western Europe. But especially U.S., that does not increase a lot. Just 15.
Did you say somewhere that they had 5 factories in Asia?
Yes.
Yes.
And are those relatively new, if they're?
Yeah, they are pretty much existing factories, but then as such, as you can see from the figures, they have not yet started contributing to a majority of the income of John Deere. So they're still in the process of something which we should note about the farming industry with regard to Brazil, India, and China. We have a lot of government participation where they are pretty much giving a lot of subsidies to farmers directly, in order to purchase much more efficient equipment. So that is a big yes for John Deere as a company.
So John Deere is a big company, but Caterpillar, one of their competitors, is even larger.
Yes.
And we talked about barriers to entry. There's barriers to entry in this industry, but there's other players. And it seemed to me that these emerging markets are wide open and people are moving in. Is there any reason why we, John Deere, would have an advantage or disadvantage when compared to Caterpillar, for example, which is already beyond the barriers to entry,
Well,
and some of the other players?
let's come to the threat to substitute. I think John Deere and Caterpillar, they are pretty much in the same segment, but their tractors and the factors are really different from each other, and for terms of use and efficiency and expectation for the users. So we're thinking of, we understand that Caterpillar's expansion and its recent acquisition will also push up John Deere out of some of the segments that Caterpillar specify in, but John Deere still will maintain its market share in its existing tractors and in its existing segments. And also, we also understand that there were both challenges for both companies to satisfy the needs of the unique local markets, such as the U.S. are all like flat, and in China and India they have a lot of mountains, and their purchasing power and purchasing habits are really different from Europe. Those are both challenges. Those are challenges both companies are facing, and we're thinking that John Deere would realize it and will be able to meet it.
Another primary plus for John Deere in comparison to Caterpillar would be its financing options. As we know, one of the third main business of John Deere is financing to its own existing customers. And that gives a huge plus again for those farmers who are not quite able to meet the credit requirements of, in order to meet the credit requirements to purchase such equipment. John Deere would, kind of like be their blessing in disguise by stepping in and giving them that sort of. So this is kind of like to show what exactly are they looking at. We have taken up two specific machines. This is the 7830 tractor, which is one of their highest selling tractors, and then the 9670 combined machine, which is, so you can see initially they finance up to 70% of the amount, and then further on, effectively by year 5, they tend to close out the balance. This is what they primarily look at with regards to lending out. So this is another, and again, going back to the clientele of John Deere farmers, the loyalty factor, the moment you kind of earn their trust and earn their loyalty by financing them and kind of showing them that, yeah, we believe you, that pretty much gains them, the trust. And that's what Angela mentioned before, about 91% of their sales is repeat sales to their existing clients.
Thanks.
I kind of will state the same thing that I mentioned in the first group, and that is the idea of having a spread or a modeling of cost of capital under two different assumption sets. Your risk-free rate was 2.48 or so.
Yes, it's on the valuation data, October 10th.
And as long as you're just doing 5 years of forecasting and your terminal value is using a multiple, that risk-free rate won't get you into trouble. If your terminal value is a Gordon growth.
Oh, our terminal value, because we just want to shorten our presentation time, so I believe that to the.
But if your terminal value was a Gordon growth calculation.
It's a terminal multiple.
Right. And I'm just stating the hypothetical. If you were using that low RF, and then you did Gordon growth with that low RF, you would inflate the valuation of the company.
Yes.
As since you're just using it for 4 or 5 years of forecasting, it's probably representative for the near term, and so that's probably okay. On the growth rate itself, is that 11% revenue growth rate somewhat indicative of just mainly a recent recovery in agricultural industry revenues? In other words, is the longer term, when you go back 20, 30 years, is the revenue growth rate always going to be an 11%, 10% annual?
I didn't search that.
Actually, the industry, we didn't find the industry detail about the average 10-year, but the average 10-year revenue growth rate of John Deere is 11.2%. We use for the 50 year in the estimation, because John Deere is one of the leader of this industry, especially in the North America. It took more than 60% of the agriculture manufacturing part. So their revenue growth rate can show the most part of the level of this industry.
I mean, they do have, on the positive side of that growth rate, they've had the luxury of being able to expand internationally at a greater pace. The risk underlying skeptical analyst opinion would want to consider the idea that if commodity prices flatten or actually decline substantially, how that might impact a Deere or Caterpillar or one of the ag-related producers. But overall,